What's up, guys and gals? Welcome back to another video. Oh boy, shareholders of STOR Capital woke up Thursday morning to a surprise. For me, the news was a mixed bag, but mostly a bummer. The Net Lease Real Estate Investment Trust, or REIT, is being taken private. STOR is to be acquired by GIC and Oak Street for a price tag of $14 billion. Current shareholders will receive a cash payment of $32.25 per share. On the news, the stock shot up 20% to match that value, so like it or not, as a STOR shareholder, you're going to have some cash to reallocate, and I wanted to highlight a few REITs I think are currently interesting for dividend growth investors. This is the Dividend Growth Income channel, where we're all about building our passive income with high quality dividend growth stocks. I'm Nick, thanks for joining me today. I do want to emphasize that I'm really just a regular guy and not a financial advisor. Nothing in this video should be taken as financial advice. This video is for entertainment purposes only. Investing in the stock market carries risk, so please do your own due diligence. So STOR is a REIT that I've been buying up over the last summer, as I viewed it as a compelling value play with solid dividend stats. In fact, STOR was the only REIT to be held in the Berkshire Hathaway portfolio, although Warren and friends have been selling pretty heavily in 2022. I myself had no intent on selling. I did my due diligence and believe in the company for the long term. I think buyers are getting quite a value at $32 per share, and I'm bummed I won't be able to keep a piece of that pie for myself. Before this 20% jump, STOR was yielding well over 5.5% and had solid dividend growth history, raising their dividend on average 6% per year. To me, this was a gem in the real estate sector. Now, before you go selling your shares of STOR today, a few things you want to keep in mind. STOR does have 30 days to find a better offer. And there's also one final dividend payment to be made, with the next dividend of September 29th, 2022, paying 38.5 cents per share in October. Now, before we get into the list, let me quickly highlight 4 points I like to emphasize when discussing REITs. First, dividends from REITs are non-qualified, meaning they are taxed as ordinary income. This makes them ideal for tax-advantaged accounts such as Roth IRAs. Second, the payout ratios are going to be high for these companies, as REITs are required to pay out 90% of their earnings as distribution. And third, rather than look at the price to earnings, we look at adjusted funds from operations, which is similar to free cash flow for REITs. And finally, REITs do often issue shares to raise funds, so over time your ownership does get diluted. Now, knowing this, here are 4 REITs I believe make suitable replacement candidates in a dividend growth investor's portfolio. These are worth some consideration and further due diligence. Please let me know in the comments if you are a STOR shareholder yourself and what REITs are you looking at. REIT number 1, Digital Realty Trust. Digital Realty Trust, ticker DLR, is one of the largest publicly traded REITs at a $33.4 billion market cap. The company owns and operates data centers that are focused on providing data center, co-location, and interconnection solutions for both domestic and international customers. The markets have obviously had a rough year, and DLR has had it exceptionally bad. Year-to-date, DLR is down minus 35.42%, and as of September 15th, they are sitting on their 52-week low, trading around $113 per share. Is it possible the markets are overreacting here? Their price to adjusted funds from operations is 17.1, and while this is higher than the real estate sector as a whole, it is well below its average 5-year price to adjusted funds from operations of 20.6. Looking at the dividend, DLR has an impressive track record with 17 years of consecutive dividend increases, and they are very consistent with raises between 5 and 6% every year. The payout ratio is 76%, which is low for REITs. They also managed to increase their dividend during the Great Recession of 2008. Simply Safe Dividends provides a safety rating of 94, and the dividend indeed looks quite secure. Currently, DLR pays $4.88 annually, broken into quarterly payments of $1.22, paid in the months of January, March, June, and September. The stock is currently yielding 4.3%, less than STOR, but still quite respectable. That 4.3% yield is about 28% higher than DLR's historical 5-year average yield of 3.37%, which makes sense given the massive decline in share price. I see this as a value play, but it hasn't stopped going down this year, so you want to be sure you're comfortable with the fundamentals and be prepared for some short-term pain. REIT number 2, CubeSmart. CubeSmart, ticker CUBE, is a self-administered and self-managed real estate investment trust. Their properties provide customers with affordable and accessible self-storage spaces for both residential and commercial customers. They're one of the top 3 self-storage properties in the United States, and I see these all over the place in my area. The $10 billion market cap REIT is down nearly 20% year to date, not as bad as DLR, but still quite a drop. This month has been particularly ugly with a 12% drop, though we are still well above its 52-week low of $38.67 from the June 16th lows. Their price to adjusted adjusted funds from operations is 17.8%, which is above the real estate sector average of 14.6%, but a little bit below its 5-year average of 19.9%. Cube has increased its dividend for 12 years since they did cut during the Great Recession of 2008. This looks like a company committed to increasing its dividend, as its 5-year average annual dividend growth rate is just about 10%, and their last increase was particularly impressive when they raised their dividend 26%. When is the last time you got a 26% raise at your job? And with a payout ratio of 70% and a dividend safety score from Simply Safe Dividends of 61, this looks like a safe dividend to me. The current annual dividend is $1.72 per year, split into 4 quarterly payments of 43 cents in the months of January, April, July, and October. And this seems to be the most common payout schedule for quarterly paying REITs. The current yield is 3.9%, also coming up short of what STOR was paying out, but they're increasing that dividend at a faster rate than STOR was. And that 3.9% yield is right in line with its 5-year average, and by that metric, Cube is near its fair value. And you would need to get your shares at Cube by September 30th to get their next dividend payout for October 17th. Shortly after that, we will learn of the next dividend increase for January, and I do expect it's going to be in line with what they've been doing. So there's a lot of appealing qualities to Cube. From what I can see so far, this one is pretty close to its current fair value and perhaps a reasonable entry point for long-term investors who want solid dividend growth and that can stomach a short-term volatility. REIT number 3, VICI Properties. VICI Properties, ticker VICI, is a newer REIT and is in the gaming sector that acts as a landlord to casino operators. They were spun off from Caesars Entertainment real estate assets during the casino operators' bankruptcy proceedings in 2017. Nearly half of its rent comes from the Las Vegas Strip, and in fact, VICI owns nearly half of the casinos on the Strip, including the Venetian, New York, MGM Grand, and the Mirage, among many other great properties. Unlike the others on this list, the $32 billion market cap REIT has been performing well in an otherwise down market. Shares are up over 10% year to date and up 22% just in the last 6 months. VICI's price to adjusted funds from operations is 16.8, higher than both the real estate sector average of 14.6 and its own historical 5-year average of 14.4. By this metric, we're in overvalued territory. VICI has been paying and growing its dividend for 3 years. The latest increase was announced recently on September 8th at 8.3%. Quite nice. They're off to a great start. The payout ratio is 80%, a little high for hotels. Simply Safe Dividends provides a safety score of 50, which is borderline safe. I think this is mostly due to the fact that the majority of its rents are collected from 3 casino operators. Betting on this company means you are basically betting on the success of Las Vegas tourism. Casinos shut their doors for months in 2020 due to the pandemic, and casino operators are still recovering from those losses. The current annual dividend is $1.56 per share, split into quarterly payments of 39 cents paid out over the months of January, April, July, and October. The stock is yielding 4.7%, so this comes very close to replicating what STOR is paying after its rise. The yield is slightly lower than its 5-year average of 5.08%. And if you want this next dividend payment from VICI, you need to get in right now because the ex-dividend is on September 21st and it's paying out on October 6th. So what I see here is a very high quality company that is fully priced, if not a little overvalued. This is likely the highest risk, highest reward play out of this group. There is a lot to like, but if you need a good margin of safety, you may want to look elsewhere. REIT number 4, Realty Income. Realty Income, ticker O, the monthly dividend company, needs very little introduction as it's easily the most popular and well-known REIT in the market. Realty Income owns thousands of properties, mostly across America, that are leased to tenants, mostly in the retail business. This one has the most in common with STOR Capital, being a triple net lease REIT. Their top 3 tenants are Walgreens, Dollar General, and 7-Eleven, and I'm putting the top 20 up here so you can see. The tenants are primarily blue chip companies, and that's worked out pretty well. Solid names that are going to pay their rent. Their current occupancy is at 98.9%. Year to date, O is down about 10%, much better than the 18% drop the S&P has taken year to date. But over the last month, O is down over 14%, creating what I see as a potential entry point for long-term investors in an amazing company. Realty Income is a dividend aristocrat, and they've increased their dividend every year for the last 27 years, even through the Great Recession of 2008. The increases are a bit more modest than the other stocks we're highlighting, given this is a more mature company with less growth in front of it. Still, dividend increases are given every quarter at an average annual rate of about 3%. The valuation for O is starting to look appealing as its price to adjusted funds from operations is 16.3%. While this is a little higher than its average in the REIT sector, it's a bit lower than its 5-year average of 18.3. Currently, O is paying out $2.98 annually per share, split into 12 payments, 1 each month, coming in slightly under a quarter. The ex-dividend is normally on the last day of the month and pays out on the 15th of the following month. Realty Income is yielding 4.63%, which is slightly higher than its 5-year average, and comes incom's pretty close to replacing that lost income from STOR capital. ICO is old reliable in the real estate sector, and for full disclosure, I do own realty income in one of my accounts, and I love watching those monthly dividends grow. So those are my 4 picks. I think any of these 4 are compelling options to replace what we are losing with STOR capital. I'm going to continue my due diligence and come to a decision in the next few days as to which direction I'm going. I only own realty income out of this group, but the other 3 are high on my watch list, and I'm looking to start a position in one of them with the money I do get from STOR's buyout. And that's all for today, folks. Thank you for sticking around. I hope this gave you some ideas. REITs are an amazing way for dividend investors to increase their passive income and get some real estate exposure without the hassle of becoming a landlord. If you found this helpful, please like and subscribe, as it really helps with the growth of my little channel here. And please check me out on Twitter @DivGrowthIncome and give me a follow. I love interacting with like-minded investors. We're all aiming for our financial independence, and dividends are an amazing vehicle to help us get there. I hope you all have a wonderful day. Keep investing.